Hello friends, today we will discuss a very important issue in the series of our income tax matters. The issue is that if a company bears some expenses in the form of employee stock option plan, which is given to the employees, in which the shares are given to the employees of the company at a lesser value, which is less than the market value of the shares of the company, then whether this difference, which is already clubbed into the income of the employees, can be claimed as an expense in the books of the company who is issuing the shares or the assessee who is bearing those expenses. This matter has been discussed in the case of HEWLETT PACKARD India Software Operation Private Limited versus Deputy Commissioner of Income Tax, and this case has been reported in 117 ITR Tribunal at page number 328. The matter has been decided by Bangalore ITAT C bench and the date of the judgment is 3rd October 2022. In the present case, the Assessee company is a subsidiary company of a holding company. During the assessment year, the holding company has issued shares to the employees of the subsidiary company under the employee stock option plan under a share based compensation scheme, and whatever the expense the holding company has incurred, all those expenses has been cross charged with the subsidiary company who is the assessee in the present case. The assessee company, which is a subsidiary company, debited all the expenses into its profit and loss account, that is employee stock option plan expenses under the share based compensation scheme, and claimed it under section 37, which is a general section which says that if expenses are incurred wholly and exclusively for the purpose of the business, then those expenses can be claimed as a business expenditure. But when the assessment proceedings were going on, the learned assessing officer as well as the dispute resolution panel was of the view that these expenses are not revenue in nature, since these expenses are related to the share capital, so it cannot be said that they are revenue. The learned assessing officer was of the considered view that it is a capital expenditure and it is not a revenue expenditure, so he accordingly disallowed the employee stock option plan expenses under section 37 and made the additions accordingly, which was upheld by the dispute resolution panel also. So the assessee filed the appeal before the income tax appellate tribunal. When this matter came before the tribunal was of the opinion that whenever the shares are issued under the scheme of employee stock option plan to the employees of a company, then the purpose of issuing these shares under the ESOP is that to generate a sense of loyalty into the employees, so that the employees can work with the company for a longer period of time and the company can get the benefit with the long working period of the employees, because it reduces the labor turnover, the employees turnover ratio into the company when the shares are issued under the scheme of ESOP. So the ITAT was of the opinion that these expenses have been incurred just to retain the employees for a longer period of time for their benefit, and more importantly, whatever the difference and whatever the expense the company is incurred and claiming as an expense has already been included into the incomes of the respective employees under the valuation rules. So there is no tax leakage, there is no loss to the revenue. So these expenses are fully liable to be claimed as revenue expenditure under section 37. So the ITAT deleted the additions made by the learned assessing officer, which were confirmed by the DRP, and the assessee got the relief. At the end of this deliberation. I am repeating the name of the case. The name of the case is HEWLETT PACKARD India Software Operation Private Limited versus Deputy Commissioner of Income Tax, and this case has been reported in 117 ITR Tribunal at page number 328. The matter has been decided by Bangalore ITAT C bench, and the date of the judgment is 3rd October 2022. Thank you, friends.